Curious about commercial mortgages? On this week's Emily Now episode, we've got you covered. We're going to talk about commercial mortgages, some of the things that you may not have seen in other episodes that are important, and we're going to talk about some misconceptions about commercial mortgages as well and what you should know about them. So stay tuned. My name is Dylan Gallagher, founder of emilynow.ca. This is a weekly webisode that we put together to help people understand a little bit more about debt, in particular loans and mortgages, and we're hopeful that in watching these episodes you can learn a little bit more about what's involved so that you can make better decisions, and those better decisions might lead you to save some money for the future, maybe invest in new opportunities, or who knows, maybe you give back to the community around you. We are on Twitter at @EmilyNowCanada, where you can follow us. You can like us on Facebook. You can subscribe to us on YouTube. And you can find us on Google Plus and LinkedIn as well. Every day or every week we try to post interesting content to keep you informed of some of the things happening in the market and some of the things that you need to know about mortgages and loans. And so with each episode that we put together each week, we have a couple of questions. And so we're going to get started with this week's first question, which is, what is debt service coverage and how does it apply to a commercial mortgage? Well, debt service coverage really refers to the ability for the math anyway, when a bank or a lender is looking at your application, is there enough income to make the payments? And the quick test for a commercial mortgage is usually for every dollar of mortgage payment that there needs to be somewhere between $1.10 and $1.25 of income. And so if you're considering purchasing a commercial mortgage for your business, then the bank is going to want to see, okay, well, let's take the net income from the business and let's see if there's enough income here to pay for the mortgage payment that they're looking to borrow against. If you're looking to purchase a commercial mortgage as an investment, so you have a commercial property that you've had your eye on and you want to add it to your investment portfolio, well then the bank is going to look at the rent roll and they're going to say, is there enough net rent left over to make the mortgage payments for what is being required? And the math that they look for is for every dollar of mortgage payment they want to see more than $1 of income. And the rationale there is pretty straightforward. They want to know that the property or the business can make the payments. And so this is how they figure it out. In personal borrowing, when you get a mortgage for your home, the bank looks at it a little bit differently and they say, well, let's take all of the income that this person makes and we will allow them to spend 32% of their income on a property with related expenses, or we'll let them spend up to 44% of their income on the property, related expenses, plus other debt. So debt service coverage means, is there enough income to cover the debt payments that are required? And so emilynow.ca is one of the places you can see what that looks like. You can make it applicable to your situation, and hopefully that helps you understand a little bit about what debt service coverage means and how it relates to your commercial mortgage. The second question today is, should I consider a recourse or a non-recourse mortgage? Now this is one of those little kind of sliver of a sliver questions where individuals who have never borrowed money for a commercial property before have some assumptions that they a lot of times just include in their regular conversation with us or with banks or lenders. And one of them is, I don't want to be responsible for this mortgage. I don't want to sign a personal guarantee. I want there to be no recourse to me, meaning bank or lender, if I don't make my payments, you can't come after me. You're protected by that asset, so you go ahead and get that asset and good luck. So philosophically, there's a few problems with that presentation as a borrower. If you're not prepared to provide a guarantee or you're not prepared to be personally responsible for some measure of the debt outside of whatever asset you might be pledging as security, then that speaks to your level of commitment and interest in seeing that the loan is successful. And so a bank will look at that and say, well, we're not the owner. We don't want to own the property. We just want to lend you the money. We want to charge you interest for that. But ultimately, it's your property and you should take care of it. So if you want no recourse, meaning you just want us to go after the property by itself, then we either have to really love the property or have to be convinced that notwithstanding we can't go after you, that we're still going to be okay to get our money back. A lot of times non-recourse financing has more to do with an individual saying, I don't want to give a personal guarantee. You can have all the corporate security that you want from my business or from my investment firm, but I don't want to give you a personal guarantee. And we hear that quite often. In some cases, the bank will say, well, as long as the company that we're getting our corporate security from, general security agreements, corporate guarantee, etc., as long as they're really strong, if something goes wrong with the mortgage, then we'll go after the company and you're okay not to give us a personal guarantee. But in the event that your company isn't that strong, then unfortunately we are going to require a personal guarantee. So should you consider a recourse or non-recourse mortgage? Well, I'm not sure there's much to consider as much as it is just understanding what it is you're actually looking for. Non-recourse financing is very difficult to get and is usually only reserved for those borrowers that are very strong financially, and because their companies have solid earnings, a big track record of history, maybe even audited financial statements, that a bank can be comfortable in taking only the corporate security and the property and leaving a personal borrower out of it. So anyway, hopefully that helps you understand a little bit about the difference between recourse and non-recourse commercial mortgages. The real-life example that I wanted to talk about today with respect to commercial mortgages is the two types of commercial mortgages that are generally in the marketplace. There are commercial mortgages to help you buy a commercial property for investment purposes, and then there are commercial mortgages for commercial properties that are going to be purchased by a business. And so we call those owner-occupied purchases versus investment property purchases. And the difference in interest from the banks is pretty significant. Some banks will only fund commercial mortgages for businesses that are buying a building and will want nothing to do with providing mortgages on investment properties. And conversely, there's banks that only want to provide mortgages on properties that are being purchased for investment only, and they do not want to give mortgages to businesses who are buying a commercial property. So not every bank is the same. Every bank has a different kind of client that they want. Some banks want investor clients, some banks want business clients, and so it's important to know that when you're going to approach them for financing. There's a difference in loan to value. If a property is going to cost you $1 million, some banks on an investment purchase basis will say, well, we only want to give you $650,000, or maybe we're okay to go to $750,000, versus giving a commercial mortgage to a business who is purchasing a property. Sometimes you can get 100% financing depending on how the deal gets put together. So the amount of equity or cash that the borrower needs is different depending on the type of commercial mortgage that they might be choosing. The way in which a bank will determine the approval is different as well. In the investment property example, they'll look to the net worth and the rent roll from the property to determine approval, versus a business looking for a commercial mortgage. They'll look at the financial statements for the business and say, can this business afford this mortgage? And so in both cases, the bank wants to see the income, but how they look at the income obviously is going to be different. And if you're going to approach a bank, it's important to understand which type of commercial mortgage you're looking for. And if you're going to be talking to them, then say, is this is this mortgage the type of mortgage that your bank likes to fund? And if you ask that question, a lot of times the banker that you're dealing with will be honest and they'll say, look, it's not really what we do, but we're happy to do it for you because you're one of our customers, but the interest rate may not be as competitive as if you maybe visited with some other banks, because it's really not the type of property that we like. And you'd be surprised, that happens quite often. So those are the two types of mortgages that we see all the time, and it's important for you, the borrower, to understand which one that you're going to be looking for, because the criteria, the income, the process can be considerably different for each, and it's just good to know that in advance. You can visit emilynow.ca to see what the difference would be. When you go through the tool, it'll give you the option to say, is this mortgage for your business? Yes, no, and if you answer each differently, then you'll see the different criteria and what it looks like. So good luck with that, and hopefully we can help you. For today's news and views segment, I wanted to just discuss some high-level misconceptions about commercial mortgages. I may have spoken about these in other episodes that you've watched, but it's always a good refresher to be reminded of some of the things that you need to know. And so there's four or five things that you should know. And the first one that you should know is that interest rates generally are higher. One of the things that we hear from people are, well, my mortgage on my home is 2.89%. You mean I can't get a commercial mortgage for 2.89%? Generally speaking, the answer is no. The interest rate is set according to the bond market, and the bond market goes kind of up and down every day. And so when a bank quotes you an interest rate, they're going to quote it higher than what you would expect on a residential mortgage. So interest rates are higher on commercial mortgages. That's a common misconception. Second thing is, and this one's the frustrating one, but the time to close a commercial mortgage is also different than a residential mortgage. When you are purchasing a home and you have to close on the 15th of the month, the residential mortgage market is highly commoditized and pretty structured so that mortgages and deals can move very quickly. In the commercial mortgage world, there is no industry-wide system, there is no industry-wide structure. Every bank has a different process for how they will approve and fund a commercial mortgage. And so we tell borrowers, look, give yourself 12 weeks or 90 days reasonably from beginning to end to make sure that your commercial mortgage gets done. And a common misconception, of course, is, well, I have to buy the property, in 21 days or in 30 days. I was able to close on something like that when I bought my home. I can't do that with a building. The answer is no. So time to close is longer. That's a common misconception. The level of due diligence and the costs associated with due diligence are greater. So an appraisal on a residential property could cost you a couple $100. An appraisal on a commercial property is going to cost you a couple $1,000. When you get a home inspection done on your house, again, a couple $100. You get it done on a building, thousands of dollars. As well, in addition to those sorts of costs, you might need an environmental report. You might need a mechanical report. The legal fees are going to be different, and so the costs associated with a commercial mortgage can be considerably higher than a residential mortgage. And so these misconceptions aren't a bad thing, but it's important for you to know those misconceptions, that interest rates are higher, it takes longer to close, that due diligence, when a bank is going through your paperwork, it can be more expensive. That way you can set yourself up for success. So if you're considering purchasing a commercial property, either for your business or investment purposes, you can get lots of the answers that you're going to need at emilynow.ca. And if you choose, you can open a file on the portal as well, and we can give you some comments on your documents. We can help point you to the right lender. You're going to ultimately get a score, and that score gives you the probability of being approved, and we can also help you improve that score as well. So we thank you for tuning in to this Emily Now episode, and we look forward to seeing you next time.